is one thing that change design. Oh no, I can't. Yes, I can do that because I think it might be better if we see us. Right, there we go. Welcome everybody. Really good to see you all here. There's lots of people here. It's been such a busy month for results. Graham did have a brief holiday, but he's fallen right back into a complete tsunami of results. And the team have been processing all the news. I've been reading the RNS every single morning and greatly enjoying it. And we are going to be giving you a bit of a presentation today, which a big discussion really between Graham and I about some of the key themes that we've picked up in this results season. So just to introduce ourselves, I'm Ed Croft. I'm the founder at Stockopedia. And Graham, your company's editor. And I would say we've really got slightly different styles. I'm definitely more of a data-driven and momentum-leaning investor. And how would you describe yourself?
I love all the good stuff, quality, value, all that sort of good stuff.
And you're definitely much more in the weeds of, qualitative analysis and so on. I tell you what I find is that I buy shares normally because of the numbers and the stock ranks. And then as I own them, I get to know them so well. And that makes it really hard for me to sell them. I've become an expert by the time I've finished with them. But today, we are going to be giving a quick recap on some recent research from the site in the last sort of 6 months and however many years, and then cover which will help you kind of understand what to do and how to react to some of the news stories as they come out. Then we're going to give a few slides on the market backdrop, interest rates, inflation, etc., valuations. And then the meat of the whole discussion will be all around UK interim results and trading statements, which have been coming thick and fast right through September, and mainly around a few themes, which we'll introduce in a moment, and talking about stocks of note. And then at the end, I've got a list of 12 shares that are ahead of expectations or jumping positively on announcements. And so this should be quite a fun session. We've got so much to talk about. It's ridiculous. And we're a bit worried that we're not going to pack it all into an hour. So we're going to really try hard to keep it to an hour. And the only way we can do that is if I stop giving this intro. So let's crack on. Before we do, and we are anybody who is unsure of whether they should be investing in shares, you must talk to an advisor. We are not an advisor. We are education and information only. We analyze shares. We may own some of the shares that we talk about today. We'll try and flag it when we do, and we will flag it when we do. And please note that shares do go down as well as up. It's been rather more positive year in the stock market this year. But what I find in bullish periods is that people often buy more speculative securities, speculative small caps, and they do correct quite hard. So just be wary of that when you're getting started. Use diversification, lots of sectors. It's very, very important to manage your risk. So a quick recap. Now, in Q1 trading statement season, this chart shows you very quickly the kind of the pulse of the year. And this is from last year. But in September, this orange line is the results. And you can see that right now, Graham's come back from holiday and he's right here. And the guys on the daily stock market report are reporting all the time. And there's a huge tsunami and it stops at the end of the month. And you can see that the final results for the end of the year, they come out at the end of March. But you can see there are these blue patterns as well, which is trading statements. There's been less trading statements this month, but there have been a few. And really January is the big period. Now, we did a study at the beginning of February, just after that early season trading statements period. And we analysed and we found that there were ahead of expectations announcements were quite predictive of future returns. And so were quite significant jumps on trading announcements. So it'll be interesting to see in results season whether that holds true too. But this was a list that we'll send these slides out later, but this was a list that we put together in an article early in the year. And I just want to share it with you because these are the 12 shares. 6 of them were ahead of expectations and 6 of them had big jumps. And some of them had both. But you can see since that, which I think was February the 12th that we published an article on this, the average stock in this list is up about 18-19%. Journeo actually had a bit of a tumble today on its results, but quite good results, but it's just profit taking. And I actually own Journeo and Trufin, but I'm very pleased with that year to date. And really, what sort of got me into these sort of shares is because of, monitoring the news and figuring out where some of the action is in the market. So I think it's rather interesting. Obviously, you have to diversify because sometimes shares go down, but on average, they've been quite positive. So as I said, we'll send those shares out. And some of these shares we'll go into in a bit more detail, like CURY's and Distribution Finance Capital today. This is just a chart that shows how those stocks performed. About 20%, 18% year to date. But sometimes these sorts of shares that are a bit more volatile on news, where there can be a bit more uncertainty, they can correct harder. So in the Trump tariff, they actually corrected harder than the market and have rallied very, very strongly since. And just a reminder, please do Google Stockopedia Academy. You'll find research studies that can help you craft good rules of thumb for dealing with news. We published this earlier this year, ahead of expectations, which is all about really encouraging people that when there's good news to buy or hold your shares rather than sell them. We're all kind of think we should take a profit too quickly. But we found lots of positive expectancy with good price jumps and ahead of expectations announcements. And this is an old study that we did that shows that you should sell immediately on a profit warning. But there's a lots more nuance in those publications, so please do go check them out. So moving swiftly on, Graham, we've got a few slides here on the backdrop of the financial markets. And I thought this was really interesting on UK interest rates that are falling, but maybe not as much as we'd hoped. Any thoughts on that?
Well, I think it's great that the market can look forward to more interest rate cuts because, as soon as interest rates hit a bottom, everybody starts talking about the cycle changing and worrying about interest rates going up. We don't have to worry about that. They're still going down. I'm quite content with this sort of calm situation we have in the market right now. Yeah.
I mean, obviously, this is a chart from Capital Economics. And I think from last year, they were hoping they'd be down at 3% by now. And that's probably because rates haven't fallen as quickly as expected. That's probably why house builders haven't really performed very well. Any other sectors you think might be impacted by that?
Well, I mean, obviously, I like to focus on the financials. So every financial stock is affected by interest rates. The value of the pound is important. Is an important factor to keep an eye on. But I mean, as you know, I generally do a lot of company-specific work. So I'm always looking for the companies that won't be, that aren't too sensitive.
Yeah, absolutely. Well, obviously, inflation rates, obviously, after that pandemic spike, they came down so far, but they've been ticking up. And I was just actually looking at, I've got a chart of the gold price in a minute, but oil prices have stayed pretty low. So the petrol pump hasn't been really much inflation from there. And so, one worries a bit if there was like an oil price shock, what could happen here?
Yeah, I mean, and it does put the Bank of England in a bit of a problem. It gives it a problem, doesn't it? Because they've got their inflation target and they're not reaching it. That does make it difficult for them to cut rates. When they haven't hit their target.
Yeah, and obviously cost inputs for companies makes them, squeezes those profit margins, doesn't it, a little bit? And this is a chart of the valuation of the UK FTSE All Share, its PE ratio from this week, against European companies, the S&P 500, Australian and Japanese Nikkei 225. And you can see the UK still at quite significant discount. Yes, some of it justified. It's not really a huge growth market like America, but we've always thought, certainly, Graham, they're probably too cheap.
Yeah, I mean, it's a lot of the stocks that we looked at were extraordinarily cheap over the last few years, and it is starting to feel like some of that undervaluation has been squeezed out now by takeovers of so many decent companies. But clearly, the UK is not in favor yet. In an international context, it's still very unloved.
And in fact, in spite of the rise in the stock market, this actually shows the FTSE All Share year to date has almost matched the S&P 500, which probably might surprise everybody. Nikkei's beating them all, but we're beating Europe, etc. this year to date. Timeframes matter here, but I actually looked at this and I was so surprised that the P ratio is lower than it was a year ago for the FTSE All Share. So, price, the share price are going up a bit, but not necessarily keeping up with the earnings. So yeah, loads and loads of bids, lots of takeovers, quite frustrating. I know you're going to be talking about one later, but at least one, I'm sure. But I personally have one rule of thumb with stock markets, because and I read this in a Marty Zweig book when I was really much younger, in my 20s. And he's this classic quote: "Don't fight the tape, don't fight the Fed." And what that means, if I unpack that, is you always want, if markets are going up, you want to be long. Okay. So the tape is a momentum up. And don't fight the Fed means if they're cutting interest rates, you want to be long. If interest rates are going up, you want to be cautious. So if share prices are going down, interest rates up, just, raise a lot of cash. But in this environment, rates coming down, markets going up, it pays to be long. And I think we've been finding that all year, haven't we?
Absolutely. And, my technical analyst, the technical analyst in me is agreeing with you 100%. And obviously you've got to go with the trends. The big trends is why we invest, I don't invest to make 5%, 10%, I'm in it for the big move if I can get it.
Absolutely. So good. Well, I know that Graham has a previous incarnation as a technical analyst, and I think I'd like to hear that lots of people questioning about that on the DSMR tomorrow. Right. Last chart, and this is just some context of something we'll talk about in a while, because we are going to talk about some junior golds. This gold price has gone absolutely crazy. Lots of central bank buying, etc. We don't need to dwell on the reasons why. I'm sure everybody understands why. But one thing to remember is that the gold miners, they have these all-in sustainable costs, sort of around, depends on the company, $1,200, $1,700 an ounce. And all the rest of this becomes margin. And this is why all these gold shares are absolutely flying and taking off, because they're spitting off cash flow. We'll come back to that in a little while, because we've got a little agenda. So we're going to be talking about a range of themes, and thanks for everybody for writing in. It's going to be hugely challenging. We're already over our 10 minutes for the intro. We're going to start with some investing companies, the markets and so on. We're going to talk about consumer retail and holiday companies, a little brief interlude on game developers. Everyone's asked a lot about defense stocks, which Graham and I both agree is not our forte, but we are going to give some chat about. Government contractors, I own a couple, and I think it's a really interesting area. Gold producers really more on the junior gold, but you could apply it to the senior golds as well. And then Graham's really good on lenders and finance, and there's also a few housing linked services. And if we've got any time at the end, we'll talk about some more. But we're going to try and whiz through this and keep it nice and tight. But you'll hear lots of names. We will send the replay, and we will send some slides out after. So anyway, let's go straight into it. Now, one thing that caught my eye was Peel Hunt this week, which did announce it was, I think, ahead of expectations in its news story. It came out with a trading update, and it basically said that it was the full year results were going to be ahead of market expectations. And I love those words. And the shares popped up on the day, and they said a couple of things. They said their execution services business was materially ahead of last year, which is Peel Hunt does 17% of the dealing on London Stock Exchange. And so that's a good sign. Volumes are up. And they also said their M&A and equity capital markets departments were up. So I like seeing that a broker is being positive about the stock market. What do you think, Graham?
Yeah, well, look, I've had this on my watch list because I'm hoping that this is going to be on the next Numis, another investment bank that got taken out. That one got taken out by Deutsche. I'm sure there's lots of bigger banks that would love to own Peel Hunt. It has working capital of I think £86 million last reported. So huge balance sheet support there, and their research is spectacular. It's some of the highest quality equity research in the city. And their client base is really high quality as well. And they've got more FTSE 350 clients now. They've got 58 FTSE 350 clients. Yeah. So even though it's a small bank, it's got a big impact on, mid caps. It's not just a small cap broker. So
and lots of M&A deals flying through too. And I think you and I both spotted there's going to be I don't know whether Peel Hunt are doing it, but there's going to be an IPO next week on Friday. I think it's a sort of at-home beauty group, which actually looks really interesting. And so it's good to see a nice IPO, a good growth company IPOing on the UK stock market. And I think like one thing I'd say is I've been waiting for the turn in I mean, it's only really Peel Hunt and Cavendish are the small brokers, but when volumes sort of do increase on the and we start seeing more floats and more research and maybe even a change to the research environment, which has been much mooted, these companies could do very, very well. They must have a lot of leverage to increase activity. So anyway, that was my first observation. And then I thought, obviously you're an ex-fund manager, and I think you know a lot about the fund management companies. And again, if volumes, if money starts coming back into the UK stock market and things improve, and then, some of the animal spirits start coming back in retail investors and they start investing domestically, well, fund management companies could do rather well. And Jupiter is probably the top ranked share on the site. And I know there might be a lot of holders here today. Do you want to tell a little what's going on here?
Yeah, so Jupiter is, it's an old name in fund management, and the big news is the acquisition that they're going for. It's a £100 million acquisition that will bring in about 15 billion pounds of AUM. So they're increasing the size of the business effectively by a third, and it's costing them about a seventh of their market cap. So it's a very interesting deal. It might be a little bit lower margin than their existing business, but the key point is that these fund managers have been depressed for a long time, for years, and the market is pricing it. It has been pricing it like it's a cigarette company or something.
Yeah, I mean, look at that.
It's just finished.
That long-term chart is amazing, isn't it? A lot of people, private investors, they look for bowls, and look at Jupiter. I mean, it's come down, and okay, active management's been in decline and passive's eating its lunch, etc. They're going to have 60 billion under management, aren't they? And you look at this, it's come down, it's based, and I love, you and I, well, you've got some technical analysis history, but I really like seeing a chart like this, because although it's terrifying on a 1 year view, you go, oh my God, it's sort of doubled. And you think, no way I could buy it now. That's what everyone else is thinking. And if forecasts are kind of are well behind the curve, which they could well be, then things can move. I noticed, so there was that jump on the acquisition, then there was a big jump, I think, on one of the big brokers upgraded it. Might have even been Peel Hunt. And so the brokers start ratcheting up their numbers, and then down here you see what happens. The brokers start ratcheting up the numbers, and they always tend to be behind the curve. So that was an interesting one. Right, you've got a couple of minutes. You can either finish up on Jupiter or give us your other favorite fund managers.
So with Jupiter, I guess, the important thing that I take from these fund managers is that they're cash rich. So there's no panic. It's not like in other sectors where the wheels can completely come off. These are cash rich companies. They're very profitable. They've got incredible operating leverage. So they have the capacity to grow almost cost free. So that's just my big picture view on the fund managers. Obviously, do your own research. There's no guarantees, but I do love the sector. My favorites are probably Polar Capital, Impacts, which I own personally, and Mercia Asset Management had results today. And I think all three of those have their own relative attractions. I mean, I could give a lecture on the sector. To be honest, we don't have the time for it.
We could probably do an hour on that alone, actually.
Yeah.
I mean, Polar and Jupiter are like 98, 99 stock rank. And if any of you don't know our stock ranks, we're not going to explain them really much in this, but we obviously analyze the quality, value, and momentum of every share. And they've high rank shares have had a tendency on average to outperform, but the ranks move around through the year, et cetera, and often when things are turning, like they can go very quickly from a lower rank to a high rank. So talk us through Mercia.
Yeah, so Mercia is quite interesting because they've changed their business model, and that that makes it quite a complicated story. You know, when you've got a complicated story in a small cap, most people aren't going to figure out what's happening. And it's basically that they were making their own direct investments. They have a direct investment portfolio, and now they're concentrating on third-party fund management, and their niche is investing in the UK's regions. So I guess there's a clue in the name, Mercia, that they're investing outside of London. And that's what I love finding in a fund manager, is that they're doing something different, that, you know, a real differentiated point, and they have been growing their funds under management, you know, against the trend in the conventional fund managers. It's been so difficult for so long, but these guys have been raising funds, and not only that, but their market cap is actually at a discount to their balance sheet. So you've got a big balance sheet story there as well. So this is an example of
the rule of thumb there is price to book value. So, you know, book value being the kind of, you know, equity, the book value in the business, and the market cap against that. It shows that it's trading about 25% discount to the assets in the business. And I spotted like 40 million of that is cash, and really interesting. Yeah. So for me, the PE multiple is irrelevant in this particular case. But obviously, it's not that I don't care about the PE ratio, but there's other interesting features of that behind that story. Okay, great. Well, you'll have to like write up. Well, I guess did you say they reported today? Do you have some notes? I did a little note on them today. They had a short update today, which basically just said everything is fine. There's this great banner at the top of the site. So if there is a comment today, you can just click through and view it, which is brilliant. So you'll find it in today's report if you do that on the site. Okay, right. We got to go. And I know that you have a real sweet spot for the spread betting companies, IG, CMC, and Plus, and these companies often they're often on low valuations because everyone's always worried about regulatory risk with them, aren't they? A little bit, but you know, IG on 94 stock rank, Plus is, as you know, regular. I know it's regularly, it's always a 90 plus share, and it's just done so well over many years. And I'm always astonished at how much cash this company makes. But you know, I think IG is your favorite. Yeah, so I own IG, and I've owned it for many years. So I'm a perma bull when it comes to this one. I did write a more in-depth article about it for Stockopedia recently. Yeah. And in that article, I said there's two main risks. The first risk is regulation, but I do think that in the UK, regulation is fairly settled. There's a lot of, I don't want to go into the history. It's a bit complicated, but we have a much more tightly regulated spread betting situation now than we did before, and a lot of that came from the EU. It's still in place now, and that's fine. But the other risk is just when volatility calms down, people trade less. Yeah. And you know, and that's one of the things I love about this stock and the whole sector is if this is in a portfolio, it's probably going to do quite well when markets are panicking, because VIX spikes up. And, you know, VIX had a really important high in April. It reached the highest level, I think, since I think it was COVID and 2008 were the only like higher levels in terms of volatility when Trump announced his tariffs. So that was a huge incentive for people to get trading in April. So IG, you can see the banner at the top there. IG actually put out their Q1 update today, and you know, things have obviously calmed down a little bit, but I mean, as a long-term hold, I don't see any change in the attractions. Also, I mean, it looked like it had 1.5 billion in cash, and it's on a very low multiple. And the dividend it's almost like a dividend aristocrat in the UK. It just keeps raising its dividend every year. So quality dividend investors, it's terrific. Well, no, do check out. There's a really in-depth article on IG on the site. by Graham. If you look at it, you can capture on the chart here, actually. No, it was there. IG is the trend still our friend, or in the discussion part. But we've got to move on. So I wanted to talk about have a little chat about consumer stocks, because there's been sort of mixed messages. There's been some really good announcements, and there's been some sort of tricky ones. And I think, if we start, there was a couple that have been in the NAPS portfolio and have done really well all years. One is Currys, and Currys will all know, they do all the electrics and they do all the big stores. But they've got a Nordics, they own some business in the Nordics, and they've got all kinds of sort of recurring revenue add-ons, and they're even going into like B2B and mobile services and so on. And they just keep beating the numbers. The strategy is really working. And again, these have been beaten down. So they got beaten down to some really low valuation, and then since then it's been beat after beat, and the strategy is really working. Now it's not like huge growth, but they're really focused on profitable segments, and it's going well. And I believe Kingfisher's another one not too dissimilar, and that's in the NAPS too. I don't know Kingfisher as well, but there was a big sort of up surprise. You can see a huge jump in the share price just a few days ago. Were you back then?
Yes, I think I was there. I was looking at Kingfisher that day as well. But what I've been trying to do, Ed, is I've been trying to get a read on the macro from what these companies are saying and what they're doing. So, for example, Currys, it had like-for-like revenue growth of 3%, and I think they're saying that they're gaining market share. And so if you're gaining market share with like-for-like growth of 3%,
yes,
that says that the market isn't doing very well.
Yeah.
Now, I'm not saying this to be negative about Currys. I actually upgraded our stance on it, and I've been really impressed by the quality of Currys' investor communication has been excellent for the past year, like almost as good as Next, which I own shares in. It's been at that level of sort of clarity almost. And they've got a great balance sheet with cash now, which I think is very important for, because it's such an inherently risky business model. You need that sort of safety net.
Yeah, and they you're seeing so many of these buybacks from these retailers. 50 million they announced. They're buying back shares, and that's great for EPS over the long term. And I've one theme, I haven't written any notes up on it, but the number of buybacks that are being announced is quite amazing.
Oh yeah. I mean, and I generally take a positive view on buybacks, which I know is controversial, but it really depends on the price that the company is paying, and if the company is being, price sensitive. So Next, which again I own, has is very price sensitive about whether or not it will engage in buybacks. Another company I just wanted to mention was DFS, because they were in the news today.
Yes,
and they had a very interesting sort of comment. Now they are talking about upholstery, which is obviously different to Currys and Kingfisher, but they were basically giving all the positives and the negative factors affecting consumer sentiment. And it seemed to me that if you tried to summarize it, you would just say they were neutral, not really positive, not really negative, very finely balanced. And I don't like DFS as a stock, but I just think if you want to get a read on the consumer, I'm just getting a totally neutral, balanced
there was
view
something,
from companies.
I think I saw it in your report this today. If I search for your DFS, there it was. What is that? Is this the quote? Consumer confidence remains below the long-term average, and inflation remains elevated, but housing transactions have been recovering. Consumer savings levels are relatively high, and interest rates look set to fall. So it's kind of like, stuck in the middle, things pulling every way.
Yeah, and I was happy to give them an upgrade, but I still find that one riskier than the other ones.
Well, I think that they're all focused so much on like operational. The good companies are really focused on their, operational efficiency. You saw only a few percent up in Currys, but then I think PBT, profit before tax, was up 37%, which is like super impressive. And so they're getting that kind of that leverage coming through of just cost cutting and focusing on profitable lines. But we should shift onto the some favorite companies in the community. one of our really, really long-term winner and big one in the big multi-bagger study we did was Jet2, because this has been running for so long, an amazing story. And I remember it was a 100 stock rank way back in 2013, and it's been such an impressive business. But we've had kind of quite weak numbers, and the shares have suffered, and the share price has gone the wrong way. And my understanding is it's because they're saying, well, actually they're still getting plenty of holidays, but people are just waiting later, and so there is uncertainty about the Christmas period. And I think didn't On the Beach say the same thing this week?
Yeah, so it's On the Beach is the most recent company to say this. Jet2 said it before, and On the Beach is a company I really like as a concept of a platform, a web platform, taking money from companies with a more traditional format. But basically, On the Beach have said that people are waiting to book their holidays, which is really bad for visibility. It means that we can be less confident in how the company is going to do. People are, and that it comes back to consumer confidence. Are people feeling a little bit nervous about how they're going to be doing next year?
Everyone's been so squeezed on taxes, and probably there's so many taxes that have been raised, and people are concerned about pay rises and what's going to happen in the budget in November and all the rest. And so people are just deferring, especially on holidays, which are often kind of more expensive commitments, and that's why the share price got really hammered. Even though I actually thought that it was quite a good set of numbers. I think they were really ramping up their TTV. I did read the report. But yeah, I mean, I see that's the thing. I have owned this in the past, and I remember I think their chairman bought a huge slug of shares here, and I owned it for quite a bit of this ride. But I didn't partake in this one, but I don't like share prices that are being hit. I mean, value investor, you might think that's an opportunity if you like the business, and I know a lot of value investors who have been buying Jet2. But yeah, we got so much to cover. We have another little fun consumer segment, which I'm keen for us to chat about, which is video games, which I was actually rather pleasantly surprised to find you knew lots about. And I think you might, maybe you're a serial gamer at home. I don't know. But Frontier Developments, which was a huge winner for the NAPS portfolio. What's going on here? Hang on. I seem to have I got a connection problem? Let me see. Okay, FDEV. Don't let me down. There we go. Frontier Developments was a huge winner for the NAPS portfolio in the pandemic. It hit a sort of 90 stock rank and absolutely rocketed. But then it lost 95%. And only recently, about a year ago, or less than a year, in January, there was suddenly like big announcement, big news, or big jump anyway. And then it's been on a bit of a tear since. But this is another one of those shares prices which got a little bit of a bowl. So tell us about Frontier Developments.
Well, I kind of view this in the same way, and we talked about this privately. I kind of view this as I would a movie studio. They've got a big blockbuster hit coming out, and it's either going to do really well or it's not. And okay, Frontier are focusing more on sequels now, but their big release that's coming up in October the 21st, we'll have Jurassic World Evolution 3. And
after we spoke about it, I actually did go and look at the video on YouTube. It's amazing. I mean, it's amazing. So you can simulate and build your own Jurassic Worlds, and you will all have seen the movie at some point. But apparently, yeah, I mean, it does look like an amazing bit of software. And if the game is successful, presumably that's, it could do wonders for the share price.
Yeah, and so I will totally acknowledge that Frontier Developments is much better value than it was before. And I have been price sensitive about Frontier. I think I turned positive on it too soon, as usual, but it's got a real chance now to do well. But that is just the risk. If I was owning Frontier Developments, I would be on the message boards, and I'd be on all the little, wherever the people are talking about the game and figuring out what is the sentiment around this game? Figure that out as soon as possible, because that's the main event here.
And I mean, I think they announced a buyback too, and the profits. By the way, I did look at the results. I think were they said they were kind of like going to beat the numbers and so on, and it pushed the share price up, and it's trending up. But I think revenues were fairly flat. But what they be again another company that's really stripped out so much cost. And the profitability just absolutely shot up, and they announced a buyback. And I think you're seeing this so much. And the interesting thing is that the whole sector seems to be in a bit of recovery, doesn't it? Because there's Everplay is the other interesting one. It used to be called Team 17. What's the difference between Frontier Developments have got their kind of the creative management simulation kind of approach,
right?
They have those simulation universes. Planet Zoo and they even have Elite, which I played a lot when I was a kid. And I mustn't download it because I'll just end up losing hours. But Everplay, they're even more diversified, aren't they?
So Everplay is an indie developer and publisher. Now, indie is this totally different type of game. It's the type of game that's very cheap, that it takes up very little space on your device, and it's very cheap to develop. And you can, companies can pump out loads and loads of these little indie games. So it's a lower risk sort of business model, but you're not going to have the sort of, incredible success of the flagship titles. They're not the flagship titles. And I mean, yourself, Worms has been sold for decades. People will always buy Worms, and I loved Worms. And if somebody offered me a game of Worms right now, I'd probably say yeah. But you're not going to spend £100 on it as your Christmas present.
No, exactly. So you've got the premium end, and the more big hit end is Frontier Developments. And even though they got their back catalogue stuff, Everplay is a bit more of a kind of indie diversified play.
Well, Everplay is probably a better, sort of a safer investment, because they have all this back catalog revenue that's very predictable.
Yeah. I mean, they've all come on my radar because the ranks have all sort of popped up, and, suddenly got interest in the whole sector. Well, there's another one, Tiny Build, but let's not lose time there, because I know, because we've got so much to get through, but I believe Tiny Build, they had a CEO, blew loads of money, and they raised loads of money and blew it, and it's still loss making. So you can always go and check that out. Now, defense. Now, I don't pretend to be an expert, but obviously we all know what's going on in defense, and a lot of you actually wrote in to ask about it, and I think we should start this conversation with a company that neither of us is an expert about, neither of us owns, Goodwin, which I know we both know some pretty serious investors who have a large slug of Goodwin in their portfolios. I would say, and my lord, they've been right. And my understanding has always been that Goodwin is sort of very diversified engineering sort of components firm, and they and that's one of the reasons people are quite happy to own quite a lot of it, is because it's so diversified. But a couple of days ago, it was up 20% on a huge new contract. Have you got the details?
Yeah, so it's an amazing contract with Northrop. Which sounds like it will be, be a sort of a step change in the business. $200 million of revenues.
It's huge for a company, because it only does 200 million sterling, and if they could make 200 million from one contract, it won't all be in 1 year. But and also this is the first lever into the defense sector. I was thinking, is this now the supply chain effect of all this new government spending just filtering out through and finding these kind of engineering components firms, and then these ones benefiting?
Yep. I mean, look, that perhaps, but I would like to add that they also said yesterday that they're going to be the sole supplier for a component in this Northrop deal, which would be another 25 to 30% of the value of the agreement. But the big picture at Goodwin is that it's a company. It's a perfect example of a company that has not cared about its stock market listing, which paradoxically makes it such a great investment. It's a family business, majority owned by the Goodwin family. run by the Goodwin family.
You're right. So the top shareholder, one Goodwin, owns 50%, which is rather handy when the market caps jump to $1 billion. But then you can see all down, and you should always go and check the major shareholders list, because you can see that the Goodwin family own a huge proportion of the company in the top holders. So possibly not that. Is it that liquid? Or, I mean, I guess it's a bigger company.
No, I don't think it's particularly liquid. And I'm sure someone will correct me if I'm wrong, but I'm pretty sure that this company had a website similar to Berkshire Hathaway's, which I own. A plain HTML page with virtually nothing on it, and they only changed that a couple of years ago. I guess it was embarrassing for them to just have such a plain website, but they also have no broker forecasts. Even though it's a FTSE 350 stock, it's worth £1 billion now. Still exactly. No forecasts.
There's no forecast at all. It's great. It's unbelievable. So you don't. I'll talk about broker forecasts in a minute, because they're invariably wrong. I've got a great example of that in a minute. We'll come on to the contractors in a mo. Okay, well, that's Goodwin, and I think that chart, although it's terrifying, it's telling us something. And okay, historic P of 41, but the growth here, it's going to come down with this defense spending that we're seeing. Now, I know everybody, I don't own Rolls-Royce. I wish I did. But this has been an absolute case study we've watched it over the last few years. And if I knew then what I know now about these ahead of expectations announcements, and also we've done loads of research in directors' dealings, this company has smashed the lights out for several years. And the smoothness of this trend, I wrote an article called, I think it was in the War Paint article in May 2024, and which is all about smooth trends. And it was at £4.56. It's now almost triple the price it was then, and it's just kept knocking the lights out. And I don't know the challenge. I mean, my understanding is there's all kinds of transformation going on here, and also they get all the aftermarket service, as well, and I believe they've even got data center exposure, and there's all kinds of things adding torque to the company. But I'm no expert, but I we were looking at Rheinmetall yesterday, which is on a P of almost 50, forecast P of 50. Rolls-Royce only on 38, which seems cheap in comparison.
Yeah. I mean, I went back and just checked. We haven't had news in September yet, but in July we had the interims, and Rolls-Royce, they did a really, really huge upgrade to their guidance for the current for this year. So their free cash flow guidance went from 2.8 billion at the midpoint to over 3 billion. Wow. So that was a really good upgrade. But then you look at the market cap, and I have to say it makes me nervous at this level.
I know. I mean, this is, I think you and I both have got a value bias, and it can be quite hard to buy these companies on punchy valuations. And I always try and train myself out of it. But the chart is still so smooth trending. I wouldn't be surprised if it keeps trucking. But I think, one has to be very careful. Our experience with really high flyers is that they can turn into falling stars very quickly. And when the brokers cut numbers, and if the cycle changes, it can be rather negative. But the thing is, with all these European nations, it's significantly increasing their spending as a percent of their GDP. You wonder when it's going to end, and you just see the impact on a company like Babcock earlier this. Oh no, not that one. Babcock, the British one, and Babcock earlier in the year. I mean, this is heavy exposure, nuclear and marine, and just gone through this massive cycle of really announcing how well it's doing, and you can see the share price there has almost tripled, and it's still on only a forecast P of 21. And as I said, I'm no expert on these companies. I watch the numbers and I watch the share prices go up. Do you know Babcock at all?
I know about it, but I haven't studied it in detail. I did take a look at Cohort today.
Yes.
Cohort was out, and okay, this might be stating the obvious, but they said geopolitical tensions are driving increased investment in defense, and they're creating conditions for organic growth. So,
Yeah.
Okay, it's stating the obvious, but clearly, it's very pleasant for the likes of Cohort right now.
I know, I'm sure. I mean, for me, so I'm annoyed with myself because, I often talk about the 90-70 rule, and I watched this and it started breaking out. I was like, okay, I should have bought it then. I didn't, and it shot away and I didn't buy it. And then it went from 5 quid, tripled, and then the share price dropped. The stock rank dropped 70, and that would have been a perfect case study of the 90-70 rule. Now it's dropped 53, and I mean it's a great business. It's a wonderful business, and but it's punchy valuation, and I haven't read your report, but
well, my impression, again, I'm not a defense expert by any means, by any stretch of the imagination, but my understanding of Cohort is that they've proven that they're good at acquisitions, and when you get a sort of management team and a company that's proven to be good at that, it can be worth paying a high valuation for. So I'm not that scared by valuation at Cohort, to be honest.
Yeah. Okay. Well, let's move on to. I want to just talk a little bit about government contractors, because this is an area I've been getting to know more and more about, because I own some shares in this sector, including Morgan Sindall, and of course, as I buy these shares, I get to know more and more about them, because I start becoming really worried when the share prices sort of only go up, and you sort of want to be more confident in your holding. Now, many of these shares, like Morgan Sindall, which is and Galliford Try, which had terrific numbers this week or last week. You can see this big jump in Galliford Try, again a 97 stock rank, and really you can see this extraordinary share price chart on some of these. Kier is another one, and I know we can maybe talk about MTEC in a mo, but because that's a kind of a small cap in a different sort of area. The ones I was talking about are in constructions area, and you can see some of them have still got quite low PE ratios and so on. And there was an old blow up of Carillion in 2018, which was a contractor that totally overextended itself, and it was in that old world of like they'd all bid and compete to win the deal, and then of course they bid too low, and then they blow up because the cost would be too high, or they get hit by inflation or whatever. So Carillion blew up, but the whole way these contractors are being dealt with by government and big bodies now is that they are creating these things called frameworks, and the frameworks are kind of, you get into a preferred bidder sort of group, and they will almost guarantee you revenue through a cycle, a water cycle or highway cycle, and they will do some mini competitions, but always within a financial framework. And there's a kind of like they share the gains and the losses. And the way I see it, the kind of variant perception on this sector is that these are becoming recurring revenue businesses. They're becoming they aren't, although like they get a lot of bad rap. Everyone's like, oh, I hate low margin contractors because they've all got like really low margins. And, and if you kind of, you look at all these things and you think, well, I'm never going to buy these because they're low margin contractors and they're like Carillion and they're going to blow up. And look, let's not be, they will still be cyclical, but, and everyone's sort of worried about those low margins. But I sort of see that there's potentially, they are justifying these high multiples and potentially even more. And especially when you've got a government which is throwing a lot more money at the sector. So that's something I'm grown in a lot of confidence in holding some of these names when they're on these high ranks, even if everyone scares you off. I remember everyone used to scare us off Games Workshop in 2015. Like, I mean, the amount of, and also, there's always scare stories. But I think that's interesting. Now, MTEC they're more on the digital side. And I know you've looked at them a bit, but they're involved in some of these frameworks too, but in different, more digital areas. So, how well do you know MTEC?
I don't know it very well, but I will say that my IPO rule would have absolutely worked a blinder here. So the IPO rule, and I need to patent this or copyright it, is whenever there's an IPO, you wait until the share price has fallen by at least 50%. Or you wait at least 2 years before you even consider getting involved. And look at this, it's 2 years, fell by more than 50%, and now here we go. Yeah,
well, absolutely. And then you look at the rank history as well. It was like clearly just pile of junk at the start, and then obviously it got more resilient and more profitable through time, and then its share price been doing really, really well, but it's on a very punchy valuation now. I think they are fully public sector exposed, but this came up on my list earlier in the year. Like I think it was in January there was this huge head of expectations here and a big jump, and so it's on that slide earlier in the presentation. But that's pretty interesting. Now we are getting really in the thick of it. And anything you want to say on contractors anymore? Because we could jump onto the gold shares.
No, I think in the interest of time we could go for gold. Yeah,
let's go for gold. Okay. Well, as I said, that gold chart I showed you a little earlier. These little junior golds on the UK stock market. There's not many, but there's quite a few explorers. I don't like explorers because they're so binary, and I know a lot of people do like them, but I like the producers, which are absolutely spitting off cash flow. I own Serabi, and actually another family member owns Altin Gold, ALTN, and you'll see all of these have got crazy high stock ranks at 99, 87, and I don't own any metals exploration, but I know I certainly know one staff member who's owned metals exploration has been rather happy with year-to-date returns, and they all operate. These three I've been tracking for some time. There's a dual listed share called Thor Exploration as well. And I think that kind of what's really changed here is there's so much sort of operational gearing and also balance sheet sort of healing that goes on because they're spinning off so much cash, and net debt just keeps. You can see how quickly the net debt just in these companies has gone to zero, and so they are now able to completely self-fund exploration. So they're spinning off cash flow, they're giving some of it back to shareholders, spending some on exploration. And so, there is just even though they've sort of risen so much in price, I mean, it's terrifying. You've gone, let's say Serabi's gone from 74 to 250. You'll never, and with the gold price, obviously they're sensitive to the gold price. If the gold price slumps, you kind of like, they're going to correct probably quite hard. But if it keeps going up, and the central banks keep buying, these things are in such a sweet spot. And of course, as they're mining out, and Serabi does quite high grade underground stuff, they can really kind of improve their the amount of recoverable resources. So, but this is happening across. There's a lot of Canadian shares. You can go and screen in Canada and so on that are doing exceptionally well. And in fact, just to show you how, this is a whole sector phenomenon. If you look at the GDXJ, which is the VanEck Junior Gold Miners ETF. If you look at that over a 1 year basis, it's gone from $40 to $80. So like the average gold junior has doubled. But the scene, you look at big companies and they're absolutely flying too. So I think they're interesting to go and research. Serabi is more in Brazil, and there are very few operators that are doing gold in Brazil. But you have to be a little bit careful of political risk with these things. So diversification is quite useful. Metals exploration is in the Philippines and Nicaragua. They've had a few operating issues recently, but the sort of share price pretty much shrugged it off. Whereas Altin Gold's in Kazakhstan, and they released some results today that haven't gone through in much detail. But I think it's a really interesting sector. It's terrifying to buy shares at these levels. But what I say again is smooth trends. And I like smooth trends. I've written a lot about smooth trends, and smooth trends often tend to persist. And you can make a very good case for why these shares should double in value. They're on outrageous free cash flow yields, many of them. But anyway, we'll see what happens.
Would you have an exit plan, Ed?
Well, I yes, because I think, generally I will exit these shares either. I tend to use kind of a time-based 1 year kind of holding period, but then I reassess. And what I've noticed with the NAPs, if there was a NAPs again this year, I run some family portfolios on a NAPs basis, and Serabi would still be in it, so that would tick it on to another year. And eventually they'll run out of steam, but you hope that you've gathered enough profits along the way and top sliced a bit, so you're kind of safe. But anyway, that's my little pitch there. And I think we've got one other. Well, it's up. We're up to 55 minutes, but I know that you've got a lot of expertise in the finance, in sort of lenders, DFCH, I'm very keen to talk about. I know that was one of your top. DFCH, Time Finance. There's IPF. I know you want to talk about these. So, right, over to you.
Okay, well, look, I know people need to eat. It's dinner time. So I'll just say very briefly, I'm a holdout at IPF, International Personal Finance. I'm hoping that the New York buyer is going to come back with an even better bid, because I'm not satisfied to sell this great company at 8 times earnings. I was really excited about the prospects here, and I only got it around Christmas time, I think. And okay, I've had a good 6 months, but I wanted to hold this for years.
Yeah.
And
it's one of your highest conviction, purchases.
Absolutely, yeah. And stock rank 98, you can see there. I mean, good company. Yeah. So another, but I'm kind of
that's consumer credit. That's sort of all over. Isn't that all over Europe, or have they got kind of global?
Yeah. It's in Eastern Europe, and they're growing in Mexico. So I mean, it's okay. It's a little bit fruity. It's not your sort of standard sort of thing, but well diversified geographically. Okay, in risky countries, but I was really excited about this one. But the point I want to make about the bid situation is that the major shareholders here are sort of mainstream funds, and the fact that the buyer in New York, they made a bid, they went away, there's this kind of process, and they've come back with a higher bid. They raised their bid by about 7%, I think from 220 to 235p, and I hope that this is a sign that the fund managers who own the stock are not willing to just give it away cheaply, because that's what happened over the last couple of years. We lost a lot of good companies at, premium, they were offered, a premium of 20-30% to the prevailing share price, which in my view is not really good enough.
Well, this is extraordinary. Schroders seemed to buy another 12 million shares in September.
Well, that is it.
They bought it off Aberforth, it seems. And so, maybe they've said, well, look, I'll buy your shares and we're going to hold out here. So would you say this is a hold up till whenever the bid matures, or do you even think it's worth a buy? I mean, it's a bid process.
Yeah, I mean, look, I can't really make that call I am holding my shares.
Yeah.
I am holding my shares. I bought last Christmas. I'm still holding them. If the deal falls through, I will be happy to continue owning it. But I had a chat with management, and I put the notes up on Stockopedia when I did that. And I got on really well with them, and I thought they were very impressive. And if they do speak to me again, because they stood me up last time because it was the day of the bid, if they speak to me again, I will have to question them on why they were willing to sell the company at 7 times earnings. I don't get it.
Well, look, brilliant. I know, but there are a couple of stocks, and this is on my big jump and significantly ahead. I've been tracking materially ahead or significantly ahead announcements. They're very predictive. DFCH was materially ahead just last week. And I think they said the same thing earlier in the year in January and December, and the market sort of ignored it, and it came down, and they're doing it again. So what do you they do? Like they do a lot of inventory finance to like dealers, and you've got capital requirements. So what do you know here?
Yeah, well, this is another company where I've spoken to management, and I think the notes are up on Stockopedia. I typed them up. So I only speak to companies that I'm genuinely interested in, and these guys really stood out to me. DFCH interview, I can see it there on the page. So it looks to me as if they're still trading at a pretty decent discount to net assets.
Yeah.
Excellent growth in profits. So when I see a small lender like this, I'm hoping that the quality metrics are going to improve as they grow. So that's hopefully going to happen here. We've got big increases in estimates. So just for example, Panmure increased their FY26 estimate from 7.9p to 8.6p. So that's a good upgrade. And they're expanding. So they've been doing, as you say, dealership finance, but I think that they're going to try and do direct lending to the end consumer now, like so to the caravan buyer themselves.
Right. Okay.
Not just to the dealer.
Consumer. Brilliant.
And if you're interested, they have a bank. Is it dfcapital.bank? Yeah, dfcapital.bank. So that is where they take in, their savings.
Yeah.
Deposits.
So if I want to get like a really souped up VW transporter or a motorhome, then that I should go there.
No, it's much more boring actually. That's where you go to get 4 or 5% interest on deposit.
Well, yeah,
so they're taking the money in there and then they're lending it out at the dealerships.
That's great. I mean, I think this is one I actually my son owns this in his ISA, but based on I think a January announcement, ahead, and I think some of the things he'd written. But and I think he's still holding it, so he must be happy. And what about ASA? This came up, ASA International, which I think a huge jump a couple of days ago. And I think it's microfinance in Africa, isn't it? Like Nigeria. It's amazing.
Yeah, Africa and Asia, with a particular focus on female entrepreneurs in these regions. The average loan is $210. Wow. And they have, I think, 2.5 million customers. So it's an incredible operation when you think about it in those terms. 2.5 million people with $200 on average. I cannot pretend to be an expert in this because I was only looking at it yesterday and trying to understand what the story is, but they seem to be doing really well, and I just think it's probably it might be a nice time to research it before more people start talking about it.
Well, you've been so. I mean, it's so interesting, this dynamic here, because you were so sort of on this sector earlier in the year, and it's I never really look at financials and lenders because I don't really understand them that well. But it's interesting, isn't it? Again, a bowl, a rising stock rank. Okay, it's 63, but and then suddenly often what happens with these big jumps is like it's a leading indicator of improving financials. So often the rank often follows that. And but yeah, these things have caught my eye, and definitely for more research. Well, we've been doing a lightning tour. Is there what other we've got? We can spend 5 minutes. We'll do some Q&A for 15 minutes just when we're done. I do have a slide with 12 shares on it, which we can share. Are there any other companies we should chat about or bring up? Anything top of mind for you?
Yeah, I'd like to mention Mortgage Advice Bureau.
Yes, because
that was only on Tuesday. They had interim results, and the share price went up 9% that day. And I think it's interesting, not just like in its own right, but also as a measure of the mortgage market, because it's a broker. It's a sort of a franchised operation, and they really have been benefiting a lot this year from the increase in new mortgage lending. Refinancings have been a lot slower, but they are predicting that refinancings are going to happen a lot in H2 as deals expire from the COVID era, and so people on 3 and 5 year deals are expiring now. But the new mortgage lending is higher margin stuff, and this is a company I've had on my watch list as well because it's so high quality, being a franchise. And
look at that quality rank, 96.
And that reflects what a franchise can do, and I think it's a positive story about the property market as well, that there's activity.
No, that's really interesting. I mean, look at that earnings growth forecast. Actually, this is one I was and a lowish peg there. Always a good sign. I mean, it's not always all about the stock rank, right? You can get it very wrong. I did promise to show you something. I just want to share one thing. I'm sure you've got another share you want to talk about, but I want to share this with the attendees because this is something I've written up a lot about in the past. And I can tell you, if you look at a company like Morgan Sindall, I do own this one. And look, it's a 2 billion company. I can't move the share price. But what I wanted to do is just a case study here on which I think is so interesting. Because Morgan Sindall, you can see this kind of profit profile. It's gone from 60 million to 118, 132, 152, and they just keep. And then the forecasts are kind of pretty flat. All right. And if you look up here, EPS growth is projected by the brokers to be -4%. And you're thinking, well, why should I own a P of 14 for a -4% earnings growth? Well, I'm going to skip that and go and look somewhere else. Now, the interesting thing is, I've often said, like, high rank shares often beat forecasts. And the wonderful thing here is you can go on this print button and go and look at what the forecasts were a year ago, right? Or 2 years ago. I can go back, let's go back to kind of May 2024 and look at what earnings growth was predicted. And in this PDF, you can see a year ago, the EPS growth for the next year was -2%. And of course, what ended up coming through in the last year's profit growth was, well, I mean, look, net profits. I think in their results they were up 15% or something, and we see this again and again. It's such an interesting thing to do, is to go and look at that. If you see a low profit in high rank, low profit growth, just check that and see if there's a bit of a tendency for this, because this is what makes brokers have to ratchet up their forecasts. And it's that process of them being behind the curve that drives momentum, drives share price growth. Right. Sorry. Have you got maybe time for one last one, and then we can have a little Q&A, and then we can wrap up?
I'm happy to go straight to Q&A if we've got questions.
Well, if anyone wants us to do let's see what people have written. Why has Camel fallen? CAML. Do you know? Central Asian metals. Now, I don't know this one. Well, look, someone said, why has Camel fallen? It's down 5% today because it's ex-dividend, and that will be why. Basically, the dividend is 4.5p per share. You normally find on dividend, when it goes ex-dividend, because the dividend needs to be paid to shareholders, the share price will normally fall by about the level of the dividend that's due. Because before this date, people who bought the shares would receive the dividend, but after today, they won't. It looks like it's fallen a little bit more than the dividend. 4.5p is, well, I don't know, it would probably be about 3.5% full. So not all due to that. The rest of this, I've no idea. I'm sorry. I don't know whether... I don't think Mark has commented on that, but no, I'm sorry, I don't have any special knowledge there. Might need to check the news. I would normally go to the news tab and try and dig around and figure out why. Well, it looked like it happened on interim results there, 13% down on interim results. So I would certainly start there and have a look why. Next question: how about JD Sports? Another one of the massive multi-baggers of the last decade, and yeah, if Google Stockopedia Academy multi-baggers, and you'll find lots and lots of material on multi-baggers we've done. Jet2, Games Workshop, JD Sports, they were some of the biggest multi-baggers for 10 years, 2013 to 2023. And actually, since then, this group of multi-baggers stopped performing. So up to, we did the study about here, and it's been backwards. How well do you know JD Sports, Graham? I'm no expert.
I wouldn't say I know it much more than the average person, but we did cover it. Mark covered it yesterday.
Yeah.
And I'm just looking at his summary here. They said there was a tough retail environment and increased costs. I mean, I don't see much quality in JD. I suppose I've never felt compelled to study it in depth, but I probably missed a trick because it has been a success. Depending on when you got in, of course.
Well, I know. I mean, it was. Everyone was already. I remember everyone was always really worried because it was very high ranking for a long time. Everybody was really worried about, all the leases before they changed what was it, IFRS 16, before they changed all the kind of rules on capitalizing leases on the balance sheets. Everyone was terribly worried about the number of like leasehold outlets that companies like this had. And but then also it was very acquisitive and it just performed so brilliantly well. I haven't tracked it for some time, so I don't pretend to be an expert, but I would encourage you. Remember, you can always click show commentary. 2 ways you can go and check out all the coverage, because there's been lots of coverage on this, so popular. You can click on these from this overlay on the chart, or you can go to discussions and go and track back through the commentary. So please do check.
Yeah, we've covered it in January, May, August, and September, but I tend not to cover it. We tend to, divide things up among the team.
Yeah. Again, there's a couple of questions on RNWH, Renew Holdings. That was another one of our top 10 multi-baggers of the decade, actually. And I believe they suffered earlier in the year. And it is MTO is mighty. Yeah, another one. So obviously it depends on the company and how it's executing. But yeah, mighty, another smooth trend, 90 rank. I presume it's the same sort of picture of all these government contractors. Let me see. What alerts do you mostly use? I mean, I personally do set a few stock rank alerts. That's kind of what I use, and sometimes a stop loss. But I'm not the most avid user. But I was amazed at how many. I think I was doing the numbers, and I think we send something like 50,000 alerts a month, which amazed me. Do you use alerts?
Wow.
News alerts or anything, Graham?
No, I just see the share prices go down, and that's my alert.
There's a question here about RFX. Now, this is one that Ramsden's on. Again, this was another one, a classic one. It announced a big ahead of expectations here, and then it went on an absolute tear, and it's still drifting up. And again, it's another very high stock rank share. We haven't commented on it in this presentation. But this is somebody saying they wouldn't be surprised if it comes in ahead of expectations. Precious metal buying, pawnbroking, and the sale of high-end watches should benefit guarantees, but I wouldn't be surprised. I agree. I think what you often find is that companies that say they're reporting ahead continue reporting ahead. And in this gold environment, Ramsden's is nicely placed. And I presume, you've got... I don't really know what the picture is here in terms of the debt picture. They've got no net debt really. And it's these are good cash generative businesses. No expert. How well do you know
the travesty here is that we lost H&T, and that was such a beautiful stock. And I always thought that Ramsden's was kind of similar, but it doesn't have the pawnbroking sort of scale that H&T has. So I was really sad to see H&T go. But as an alternative, I think Ramsden's is a great company, and I've interviewed management here as well. I've got no concerns about management, and they've been expanding the business in what I think is a responsible way. And it's sort of there's a clue in the name, Ramsden's FX. There is exposure here to tourism as well. So if you're bullish on tourism, it's a nice stock as well.
Well, very interesting. I noticed the EPS growth, probably like Morgan Sindall, the brokers are saying it's going to go down. And I presume if we go back a year, they're probably saying it would go down as well. I'm just presuming. EPS growth of 1%, 2%. This is why I don't necessarily trust forecasts these days. And remember, they've stripped so much funding. All the MiFID rules, the whole research community has been really not. It's not destroyed; it still exists, but there's just so much less research at all out there. A lot of independent research, and they don't update them as much. And so that's why I personally, in these environments, like relying on, I call them the factors, but the QVM, and looking at the trends and which way the announcements are going, I think is such a good leading indicator. There is somebody actually who picked up on KMK, and I think this is a nice way to seek into this little table I pulled together today, because Chromec KMK is one I actually bought a tiny position in this week, just to disclose. Because one thing happened. I'm very I'm very stock ranks driven, and Chromec, which is literally, and you know me, I literally will never look at shares that have got stock ranks of 25, 38, etc., etc. But then all of a sudden, you know, after years and years and years of the doldrums, the share price going absolutely nowhere and everything else, it suddenly popped up to 98 stock rank, and I was like, that's weird. Nothing ever jumps that far. And but this is a very low market cap company. It'd be very liquid. So, but they basically they do kind of chemical, nuclear, biological, you know, a lot of sort of disaster kind of sensors. And they also have exposure to this sort of CT scanners where they're sort of selling into the medical market. And they suddenly got like a really great contract with Siemens. It's like $37 million or so. And I actually listened to their Q&A on Investor Meets Company, and they was and the profits will come down next year. They will not stay at these levels, so that's part of the issue. But it's quite interesting, and I wouldn't say the management was super bullish, but I just thought it's another, you know, an interesting one that there could be a turn here. And they sell this cadmium zinc telluride, I think, into, and it's a better component for sort of CT scanners and things. And the management was saying, well, what we sold this $37 million contract into is a tiny, it's like 20 times smaller than the CT scanner market. But anyway, I always say I don't buy stories, only buy statistics. So listen to nothing I say. But we put this little thing together, and this is no particular scientific method. Graham and I pulled through some, you know, I did a big data study actually, and I to find all the big jumps and their head statements, like I did earlier in the year. Some of them we've talked about: Kingfisher, Goodwin, DFCH, Trufin. It was in the early one in the year. They have a game called Balatro, and this again is a very small company. Chromec, again, that was significantly ahead in a big jump. Lots of these got big jumps. Galliford Try, Focusrite, we haven't talked about. If you've ever been a musician, that's interesting. I don't own shares. Currys and Pario, which I think does animal feeds, isn't it? Is it animal feeds? Something to do with animals. Jupiter Asset Management, we talked about. Sorry. Oh God, I've said MAB. I'll change that in slide. It's not Mitchells and Butler. It's Mortgage Advice Bureau. And ASA International was the microfinance lending company. Now, what will be interesting is I'm sure we'll do a webinar in another quarter or 6 months. And we can see if these sorts of leading indicators of jumps on these announcement days and, you know, ahead, significantly ahead, whether that has a predictive value. All the academic research says yes. We find generally that these are positive indicators, but lots of these are small caps. And you remember, these are risky shares. Some of them don't, you know, be careful, always diversify, make sure you own large caps, diversify your portfolio. If you don't know what you're doing, get an advisor. Anyway, that's pretty good. Any other questions? Graham, have you looked at the Q&A tab? You know where that is. There is a question on Card Factory if you want to finish up there. I know you like Card Factory.
Card Factory. Oh, I don't think I do like Card Factory, you know. I think other people like Card Factory. I think I said something a few months ago to the effect of, I have to be green on this, but at the end of the day, it is a card shop. So, you know, I won't. This is not the type of thing that I would add to my portfolio personally, just because I'm just so selective when it comes to retail. But obviously, it's got a lot going for it right now. It's I mean, it's incredibly attractive, you know, quantitatively, and so, I mean, you can't argue against it right now, in my view. But
I know I did own it, and then I got terribly bored in my discretionary portfolio, and I moved on to where there were more interesting things happening. And but yeah, it's a, and I know that Cockney Rebel, you know, really liked the share for a long time. I think he got bored too, and. But you know, it's a extremely well-run business. It's on a very low price earnings ratio. There were worries obviously about national insurance earlier in the year, I remember, and you know, obviously this is another one. Actually, the margins aren't too bad, but you know, and they're kind of expanding internationally. And I remember they seem to have a lot of sort of vertical supply chain alignment and all of that. But yeah, I don't own it, and didn't seem hugely exciting to me. But there we are. Well, look, it's been an hour and 20. Graham, I think we've done quite well. I'm sure everyone's brains are a little bit fried with the amount that we've covered. It's been great fun, and we should do these more often. And, if we do send through a survey tomorrow, please do add feedback. Please let us know what we could do differently, or what we found interesting, or what you didn't. And whether you want us to do more of these, because we've tried to pack so much in. If we actually did these more regularly, we could spend a bit more time on each company. But anyway, really good fun. Great that so many of you were here, and good luck in all your investing.
Absolutely. Yeah. Thanks, everybody. And lovely chatting with you, Ed.
Yeah. Cheers, Graham. Thanks so much. And take care, everybody.